Pure 103.7 FM, AM 1320, Jacksonville's Christian station, music and ministry. This is Terry Robinson, and thank you for joining us right now for Tax Tips Tuesdays with Patrick and Rains, a local accounting firm. In the studio with me is Timothy Rains. Hello, sir. How are you?
Hey, Terry. I am doing very well today. How have you been?
I am great, and great to have you back for another session of Tax Tips Tuesdays.
Yeah, happy to do it again.
So first of all, tell us about Patrick and Rains.
Well, thanks for asking. We're a full service CPA firm, so we provide everything from financial statements, which could be your regular bookkeeping, compilations, reviews, all the way up to a full-blown audit. We also do things tax compliance, but also the tax planning, the strategic side of the tax planning, as well as business consulting.
And who do you have in the studio with you today?
Yeah, today I've asked Chris Loudy, our tax director, to come in and join me. We want to talk a little bit about what's going on in our office and what we're seeing out there today.
And tell us about today's topic for the show.
We were thinking about retirement plans. We've seen a lot of those questions come up, and we thought we'd cover some good topics, good questions we get pretty regularly.
All right, then let's get started. These have been some hard times with COVID-19 slowing down the economy, and in many places even closing businesses entirely. What are some things from a tax perspective that you are seeing with your clients this year?
Many of our clients, things have been tough. Lots of people are getting laid off, but also for the retirees as well. But many people have had to take retirement draws out of their retirement plans in order to make ends meet. Usually this would be a bad idea because the IRS has a 10% penalty on the early withdrawals. But thankfully, the CARES Act, which passed in 2020, actually provides a little bit of relief. The 10% penalty is waived for COVID-related distributions up to $100,000. The rules are a little sticky. It's got to be somebody, for example, who has been directly diagnosed with COVID, or you're taking care of a family member with COVID, or you've had your hours cut, but for whatever reason, things got tight financially and you needed to dip into your retirement account. So the 10% penalty is waived. Also a great benefit, if the financial situation improves a little bit in the next couple of years, they actually give you a 3-year window where you can pay that money back into your retirement account, no harm, no foul. And then, of course, since this being such a tough time, you're having to take money out of the account. Of course, you don't have the money to pay the taxes. So Uncle Sam has actually said you can spread those income tax payments over 3 years. So that's been a really great opportunity to just stretch out that burden a little bit, help folks out.
Now, some of these retirees have really tightened up on their expenses and have had other sources of income, so they really didn't need to take withdrawals from their retirement accounts. What the CARES Act also did is it had a provision to allow them to skip their required minimum distribution from their qualified plans and IRAs for 2020 only. As of right now, they have not, waived the RMDs, so there are normal RMDs for 2021.
All right, retirement planning is something we should all do regularly in order to save money on our taxes, but the options are so confusing. Share about that.
We certainly agree that the options are complex, but the first one that we all look at is Social Security retirement. It is funded automatically from the FICA tax paid through payroll and self-employment earnings, and for most individuals, the primary source of their income in retirement. It is important that we be aware of our annual contributions, as they are largely determined by what our retirement benefits will be. Each individual's earnings record is unique, but a typical senior will receive annual Social Security benefits in around $20,000 range.
Yeah, and keep in mind that once that safety net is fulfilled, Social Security Trust Fund has kind of been dangerously underfunded. And you want to realize that there may not be enough Social Security to support you the way you're, accustomed to. So we do want to take a look at some other options.
In regards to Social Security, I was just looking up what my points were. Thankfully, I had enough points to where when I reach, 70 or what have you, I'll have, some income that's coming in. I'm 50 years old now, so I'm thinking more about what my income is going to be in 10, 20, 25 years.
Oh, yeah. And I would encourage people maybe even once a year to look at that Social Security earnings report.
Yes.
You can go online and get that. and just double check that you've gotten your points, that you've hit your 40 points, you've worked for 10 years, you get 4 points a quarter per year. Just double check that, make sure they've got all of your earnings in there. And that's a great way to allow you to kind of budget for that into the future.
Right.
Some people are shocked that may not be enough, and other people, are pleasantly surprised it's more than what they were expecting.
Yes, and to your point, making sure everything has been reported. I saw a couple of years that weren't in their system that I've got to send them the update information. I think it was because of me getting married, name change, and things like that. So very good point. How is Social Security taxed?
That's another good question. People get a lot of confusion about this. For some lower income retirees, Social Security may not be taxable at all. But keep in mind, it is on a graduated scale. So for example, in 2020, if you're a single filer and you have combined income of $25,000 to roughly $34,000, you're going to pay income tax on 50% of your Social Security benefits. Now, let me clarify. It's not 50% tax rate. It just means that 50% of your Social Security earnings will be subject to whatever bracket that you're in. And if your combined income is more than $34,000, then up to 85% of your Social Security benefits will be taxable. But thankfully, under the current law, there's no way that 100% of your Social Security earnings are going to be taxable to you.
Can you offer a simple overview of the various retirement options?
Sure. Generally, we are looking for a tax-advantaged retirement plan, and the first one that comes to mind is the individual retirement account, or the IRA as it's most commonly referred to. There are two basic options. The traditional, which is for most individuals, gives you a tax deduction for the contribution, but is taxable when you take out the distributions. The Roth, which does not provide a tax deduction, is generally tax exempt when distributed. The maximum allowable combined contributions for both 2020 and 2021 is $6,000, with an additional $1,000 for taxpayers at least 50 years of age by the last day of the tax year.
Okay, so can I assume that all the other retirement plans are based on employment tax or status?
Yeah, right. So let's break all the other plans down into two kind of buckets per se. You have the individual based plans, which are usually they're handled by an IRA custodian. And then you have the more traditional, let's think of those as your employer based plans. These are funded typically with a third party administrator. So an individual or retirement based accounts are your typical payroll deduction IRA. These, just like Chris mentioned, these is where your employer is assisting you with your IRA contributions. You also have what we call a SEP, which is a simplified employee pension. This is funded solely at the discretion of the employer, with up to 25% of your compensation, up to an annual maximum of $57,000 in 2020, and then it goes up to $58,000 in 2021. Then we have another plan, as if it's not complicated enough, called a Simple Plan. This is your savings incentive match plan for employees. So I'm really glad we shortened it to Simple. It is funded by the employee. So for 2020 and 2021, up to $13,500 can be your salary deferral. And then once you hit the 50 or older, you get what they call the catch-up, which is another $3,000.
On the other side, you have employer-sponsored defined contribution plans. Some of these include profit-sharing plans that are funded solely by the discretion of the employer, with up to 100% compensation with the annual maximums that are noted within the SEP plan. 401ks, which is one of the most common for payroll, is a plan that allows a maximum annual deferral of up to $19,500 for 2020 and 2021, plus an additional $6,500 for those at least 50 years old, and the employer can contribute up to 25% of each employee's contribution. The Safe Harbor plan is used for smaller employers to limit the matching for employers and lessen reporting. There's also an automatic enrollment plan, which allows employers to increase participation. And then traditional 401k plans require more protection of participants' rights and limits on the management benefits.
Now, there are a few other lesser known retirement plans. These are qualified plans as well. This is your 403B. You typically see these limited to not-for-profit employers such as schools, hospitals, and charities. And it's very similar to a 401k, except that the funds are kept in a tax-sheltered annuity, not in direct investment account. The employer can still make the same contributions, roughly up to that 19.5. You do get the additional catch-up of $6,500 once you hit 50. However, there's another even trickier little part. Once you hit 15 years of service, then they can bump you up again. Those rules get a little complicated, so I'll skip them, but that's just a great benefit of being in a 403b. And then the last one you typically see around state, city governments, and that's the 457b plans.
All right, if you're just tuning in, this is Tax Tips Tuesdays with Patrick and Rains. They are a local accounting firm located here on Atlantic Boulevard, and that address is 4029 Atlantic Boulevard. And they are here just giving us some valuable information on retirement. And so, any final recommendations before next week's program?
Sure. We encourage everybody to start as early as you can in regular savings for retirement. You can start small and develop that discipline. You might even take some of your stimulus check that you just received, contribute it towards a 2020 IRA, and get some tax savings from last year. Then you can increase your contributions as your resources allow. It is especially important that you make those contributions where your employer will match to allow those investments to grow faster. After all, it is a tax-free bonus.
You know, another little interesting bit of news. We all knew that the tax filing deadline has now been pushed from April 15th back to May 15th this year.
Wait a minute. I did not know that. I missed that news.
Well, that's why we're here for you. Another little interesting thing in the law is we were a bit unclear about the IRA contribution rules, because you still get up until April 15th in order to make an IRA contribution for last year. So you get a little extra time to make a contribution, get to take the deduction on your taxes. So when they moved the due date, we really weren't sure if they were going to move the due date for the IRA contribution. And we just heard Monday that yes, the IRS will allow you an extra month in order to save up to make that IRA contribution. So if you do have some extra money coming in, that might be a great place to put it and get the tax deduction.
Many people think you can't fund IRAs if you have a retirement plan at work, but that's not necessarily the case. It depends on your income. You can still contribute to and claim a deduction for your contribution if you're single and earn $66,000 or less in 2021. This increases to $105,000 if you're married and filing jointly, although it does drop down to $10,000 if you're married and file a separate return. Partial deductions are allowed over these limits to some extent, but you might be able to make a contribution on behalf of a non-working spouse.
I know that all of these retirement plans sound really, really complicated, and even some of the plans will have what they call a Roth provision in there. So not only can you do a regular retirement contribution, but if a Roth better meets your needs, a lot of these have combined. So you'll have a 401k with a Roth provision as well. But like I said, some of these are complicated, and believe me, retirement planning used to be a whole lot more messy. So I'm glad things have truly simplified. It is a good idea to go ahead and just tighten the belt a little bit today so that you'll have a more secure future. And it's a tax benefit. So we do recommend everybody, find a good financial advisor, find a good CPA, take them out to lunch, have a working relationship with them, or, email us and we'll be happy to send you a chart or talk more about it.
Absolutely. And so, Timothy, before we get ready to close out this Tax Tips Tuesday, can you think of anything else that you would like to share in the way of advice concerning savings for retiring?
Yeah, I tell people it's always hard. We start off younger in life, trying to get the first apartment, trying to get the first car. Maybe our job really isn't, paying enough. But as we progress through life and we kind of already paid for the dining room suite and we've already got the car that we want, that's a good opportunity just to say, hey, I'm getting a raise next week. Maybe I can set aside half of that. And if you kind of get into that mentality every time you get a raise or every time you change jobs, you're not going to miss it. You're just taking part of that little extra kicker that you were getting and you're setting it aside for a rainy day.
Yeah. From your perspective, how important is it that we have another source of retirement income and not just rely on Social Security?
Yeah, I think everybody has to have that. It's just too much to rely on Social Security. As we all know, rules can change. As more and more people are retiring, it does become a bigger burden. We have less and less wage earners paying into the system. So it's always a good idea to kind of just make sure you're looking out for yourself and making sure that you're setting aside some funds.
Absolutely. Well, this has been very enlightening. Thank you so much for being here on today. Patrick and Rains, a local accounting firm here in Jacksonville. Again, share a little bit about your business.
Yeah, we're not an H&R Block. We're not a walk-in type service. When we meet with clients, we like to meet with them on a regular basis. We do have some clients that just drop their stuff off, but those are people that we've spoken to and that are calling us throughout the year. It's much easier for us as a firm to do our tax planning strategies or to help your business grow from a financial perspective if we know what's going on. Accountants are really kind of moving away from the old historical bean counting, number crunching, and really going more and more into an advisory role. And if you've got a really well-trained CPA like that, you should be using them for that type of stuff. Don't be afraid to reach out to your CPA and get that advice when you need it. It's money well spent.
And how can we contact you?
Well, our phone number is 904-396-5400. You can reach our office through that number, or you can contact our office directly. My email address is chris@cpasite.com. Tim, yours?
Mine is trains@cpasite.com.
All right. And mention your website.
Sure. Our website is www.cpasite.com.
And your location.
Like you said, we're on 4029 Atlantic Boulevard, so it's right near Arlington.
All right. Thank you so much, Timothy and Chris, for being with me on today for Tax Tips Tuesdays.
Thanks for having us, Terry.